Good afternoon, everyone. Welcome to a Tricio webinar. It's probably the last one this year. We're going to talk about emerging from permacrisis and outlook for next year and see what we have in store in terms of opportunities and risks as well. My name is James Chu. I'm the head of investment solution at Tricio. I'm joined by our chief economist, Calverley, and our chief strategist, Gerry Celaya. As usual, please type any questions into your chat box on the chat box or the Q&A box. If you encounter any technical problems, again, use the chat, please, and one of us will be looking after if there are any issues there. So with that note, I will start and I hand over to John.
Thanks, James, and hello, everybody. So I'm going to talk about the outlook for this year. We're coming out of what people are calling a permacrisis. It's the word of the year, apparently. Just to remind you what we've been through over the last 10 or 12 years. We've had the global financial crisis, then the euro crisis, then Brexit, COVID, inflation crisis, Ukraine and the energy crisis, and of course in the background, the climate crisis. Now, some of these are still with us. We still have inflation. I'll talk about that in a moment. Ukraine, we still have the climate crisis. The hope is that some of these things recede and we can get back more to normal, but we'll have to see as we go forward. So in terms of the agenda today, I'm going to start by listing 5 what I would call long-term trends or challenges. Then I'm going to turn to inflation, which is the short-term issue, I think, that everybody's focused on. And then I'm going to offer 3 risks in the markets for portfolios, and Gerry will talk about 3 opportunities. I'm going to rattle through these slides quite quickly, but we will be sending copies to you, so you'll be able to catch up with them later. The first trend, I would say, is we are still optimists on technology. We've been saying this for many years. We think that technology is the answer to productivity growth over the medium term. And the areas we particularly focus on are artificial intelligence and robotics. These are 2 areas which I think can be considered general purpose technologies, in that they really can get into everything and improve the outlook for everything, just like the steam engine or electricity or computers. There's other things as well going on, the Internet of Things, additive manufacturing. And the question is whether all these things will boost the economy, and we're optimistic. We need it though, and the reason for that is that productivity growth has been quite sluggish. This is a picture for the US looking at output per hour. You can see there was a lift right after the COVID crisis when productivity appeared to jump up. Well, it's fallen back down to the trend. The trend is in green there. So it does seem as though we're still on that rather sluggish trend for productivity. And that's what we're hoping, that the technology will lift over time. The picture for the UK, I guess a lot of people on the call are from the UK, is actually not even as good as the US. This is a picture of GDP per hour worked. You can see that in the 70s, 80s, through much of the 90s, the UK was actually converging on the US. And I would put this down to membership of the European community, as it then was, which meant a gust of competition for Britain, and also the Thatcherite reforms. But then starting sometime, particularly the financial crisis, but even before that, productivity growth slowed down, and it's been very weak in the last 10 years. The US, in contrast, actually had a lift in the early 2000s, although it hasn't been doing so well since. So it's a rather bleak picture for the UK. Second big trend is the green transition. And I think we saw in 2021, particularly, this thing really taking off. Now, in my view, this means short-term pain for the economy. It's a cost. Yes, it can generate jobs and offer opportunities in business, but it's nevertheless a cost for the economy. Obviously, a long-term benefit in avoiding climate change or reducing the risks from climate change. The problem at the moment is that policy is still inadequate, but at the same time, it is damaging the short-term impact. Temperature is already up 1.1, 1.2 degrees Celsius from pre-industrial times. We saw at the recent COP meeting that they're sort of moving away from the 1.5 Celsius target. Frankly, that's impossible. So we're not doing enough, At the same time, we're doing quite a lot which is hurting the economy. High energy prices, for example. Over the last 10 years, many countries have had high energy prices because of pushing solar and wind power when they weren't cheap enough. They're getting cheaper now, but still not all the way down. And now we're in the situation where we have high gas prices, high oil prices, obviously partly because of the Ukraine war, but also because of lack of investment in those areas, despite the fact that there is still strong demand for them. So this is really still a big issue. What it means from the investment side then is it's hurting the economy. It does offer opportunities, and that's something to look at, although there's great competition in this area and also subsidies are declining now. The other big thing around this is that investment advisors face big challenges in meeting client demands on this side, on the ESG side. James has done a lot of work on this and can help you if you're interested, but it's a huge area of activity for advisors. The third trend is interest rates normalizing. I put a question mark over that because obviously we don't know where rates will be in a few years' time. This chart shows the 10-year yields and also the US TIPS yield. The TIPS yield, the real yield, is back to about 1.5%. So these are yields that we haven't seen for a very, very long time. They may not last. Our view is they will, that we'll get through what we think will be a recession over the next year or so in the US, and rates will not come back down to zero. But there obviously is a possibility they do. But if we do see interest rates normalizing into the 3, 4, 5% range instead of the 1 or 2% range for long yields and 0 for short yields, that has implications for growth stocks in particular, because it lowers the value of future profits. So it's quite an important change, and we'll be watching this one closely. Fourth trend is we had this big boost in house prices, particularly during the COVID period, but in many countries it came after a long climb in previous years. So we are seeing house prices falling. Canada, where I live now, has had the biggest increase over the last 20 years. This is in real terms, right? So this is saying that Canadian prices almost tripled in real terms. They are actually falling. This data goes to 2021. They're probably down about 15% in Canada right now. Australia as well. And the UK, we're starting to see them turn, and the US as well in some areas. So this is one of the effects of rising interest rates, which tends to hit particularly on the housing sector. So it's having quite a big impact. The fifth area is populist policies. We've seen increasing government spending and taxes during the COVID period, and this does seem to be continuing. We see that very clearly in the UK, where the share of government spending and taxes in GDP has risen. The reason for that, of course, is partly that the GDP simply isn't rising, but our demands for healthcare and education and so on do rise. So these things increase. Nevertheless, there does seem to be a trend in many countries towards that. That seems to be what people want in democratic elections. We're seeing more intervention, energy price controls, for example, in Europe, windfall taxes. Spain, for example, today we've just heard is intervening to help mortgage holders on low incomes. So a lot of intervention in the economy. We're also seeing trade protectionism creeping, I would say, rather than rampant. But one of the biggest disappointments, I suppose, of President Biden's presidency is that he's continued, essentially, the protectionism that Trump put in place. And he hasn't moved to join the TPP, the Asian Trade Partnership, which would be a huge win in terms of economics and geopolitics, but it just doesn't go in Congress to go there. At the moment, the US is not isolationist under Biden, clearly. There is a risk of that, though. If Trump were to come back or somebody like him, that's potentially going to have a big impact on the world economy and on geopolitics. And then China. China for a long time was basically focused on growth, and they didn't mind if there was big disparities of income. And they've changed that policy now. They've become, I would say, more left-wing, if I can put it that way, emphasizing common prosperity rather than maximizing growth. And alongside that, we're seeing nationalism as well, which is another characteristic of populist policies. So those are 5 long-term trends which we think will continue and which lie behind what's going on at the moment. I want to turn now to inflation. And this chart shows core inflation. The US is the personal consumer expenditure deflator, which is the one that the Federal Reserve follows closely. You can see that seems to have stabilized, but it's about 5%, and the target is 2%. In the UK, the core CPI is about 6.5%. In Europe, it's about 5%. Europe has been rising strongly and probably has further to go. The UK may have further to go as well. These are all much higher than target. And I don't believe that the central banks are content to stop if inflation comes back down to, say, 3% or so. They really do want 2%. So we're going to face a period of quite difficulties as they try to bring inflation down. Now, a key reason for that, when we look at the US and the UK, but also the Eurozone, is that unemployment is at its lowest level for decades. This is true in the Eurozone as well. And when you have unemployment this low, of course, jobs easy to find, so wages tend to rise as well. So one of the questions is, why is unemployment so low? I mean, the UK has full employment, and yet GDP is actually slightly below where it was just before COVID. The labour force is still increasing, so there should be more people available. Well, I mean, part of it is low productivity growth, of course, but there's also a problem of missing workers. This is true in the UK, where there's something like 1 million less workers than you would have expected if you'd simply extrapolated the employment line from 2019 onwards. So where are those missing workers? Well, we know that in some cases people are taking early retirement. There was a lot of talk about that last year in the US, where people were looking at the high value of their stock portfolios and the house prices, and they were deciding simply to sell out and move somewhere cheaper and retire. There may be a fear of COVID still, although that's probably fading. Long COVID seems to be a significant issue, particularly in the UK, where we have good data. And then work-life balance. People deciding, well, actually, they do want to retire early. Or one of the things we're seeing in the US is it's quite common in the US for low-skilled people to work 2 jobs or even 3 jobs. And they may be cutting back on one of them. That seems to be supported by the data, doing 2 jobs instead of 3, or 1 job instead of 2. Another factor is less immigration. In the US, there was restrictions on visas during COVID for obvious reasons. And in the UK, we've had Brexit, which together with COVID has meant that there's fewer Europeans in the country. So this is one of the reasons this missing workers issue is really keeping unemployment low. And that's driving wage growth. So this is a measure that the Fed watches closely, really measuring what's happening to wages. You can see it looks as though it might have stopped rising, but it's still too high. This needs to be somewhere around 4% or a bit below to be consistent with 2% inflation. So they need to cut out at 2%, maybe 2.5% of excess wage growth. And this, I think, is the only way to do this really is, in my view, is through a recession. That's the way that you make the labor market less tight, reduce wage offers, reduce trade union militancy, and so on. So, as you all know, interest rates are rising. This is a chart I have to update practically every week because central banks are raising rates almost every meeting. The US is out ahead at the moment with a 4% rate. This is up from 0.25% at the beginning of the year. So this is a very rapid increase. You can see the UK in there at 3% and the Eurozone at 2%. So rates rising pretty fast, and they're expected to rise further, probably at least 1 percentage point for all these countries further over the next 6 months or so. At some point they will pause, and then I think they will stay at those high levels for some time. So there won't be a very quick pivot back down again, that's my guess. Now, there is a risk that rates go much higher than I'm saying. That would really be if wages show no sign of coming down. Then I think rates could potentially go even higher. Some of the Fed governors have been saying, well, 7% is entirely possible. And I think they're just trying to make the point that they are very determined to bring inflation down. So I mentioned recession, and this is the US leading index. It's the 6-month change, which historically has been a pretty good guide to when you get a recession. And you can see that the 6-month change quite often goes to zero or even just negative. It's never been where it is now, which is about -8% on a 6-month change basis. Never been here before without a recession following within 6 months. And you can look back, this chart only goes back to the 90s, but if you go back 50 years on this, it's the same story. So it does point to recession, and a lot of other leading indicator approaches also do that. There are some special factors going on at the moment. For example, one of the things that often takes the US into recession is that the car industry slows down, demand for cars falls. People get worried about unemployment, or they see higher interest rates on lease rates. However, there is a backlog of cars at the moment. People were not able to get hold of them over the last 2.5 years because of COVID. So even if demand falls, there will probably still be enough demand coming through for the car industry to expand output in 2023. So that's an issue. And there's also seems to be a backlog in the capital goods industry, where firms want to invest and they've got new machinery on order, and the companies making that machinery have big order books. So quite how this is going to play out is still uncertain. In my view, the Fed will cause a recession because it's the only way to go. So if you see the data being quite strong, and frankly, US data in the last few weeks has been coming in quite strong, that just means higher interest rates. So our central view for 2023 is that we will see a recession in the US and in Europe and in Japan. We're obviously already in recession in the UK, probably also in Germany. And I suspect Europe is going in the fourth quarter, Europe as a whole. The US, probably not till next year. The fourth quarter looks like another strong quarter. But that leading indicator index clearly, well, to me, suggests that it's only a matter of time. And then China has been very slow this year, which is partly because of the zero COVID policy, also because of the property crisis. And I think China will be slow. I think inflation will gradually recede. And there's kind of two strands to that. One is that some of the transitory factors that have been driving inflation are falling out of the index gradually. So the prices of cars, used cars in particular, is coming down. We're seeing the transportation costs have come right down. Some of the other sort of special factors like the price of clothing, which collapsed in 2020 and then soared, that's probably going to stabilize. So those transitory factors are going to drop out, and that will slow inflation down. But then what's going to matter most is what happens to wages. Indeed, that I think is going to be the focus going forward. So as I've said, interest rates are set to rise further in the next few months and then stay high, I think, right into the following year. I don't think the Fed or other countries will pivot. And then looking for, after this recession, a recovery starting late 2023, probably at the earliest, maybe even 2024. So I'm now going to talk about 3 risks and then pass over to Gerry. So the first risk, I think, is that risk assets likely have farther to fall. We've already seen quite a big correction this year in most risk assets. I don't think they're pricing in a recession yet. Obviously, it may depend how severe the recession is. We tend to think it'll be fairly mild. Nevertheless, when you get a recession, that impacts margins, it impacts earnings, and I don't see that really in the market yet. I think markets were overvalued at the end of last year, and they've come back to more reasonable valuations. I'll show a chart on that in a moment, but they're not pricing in a recession. Another reason for worrying is there is a strong chance, I think, of a central bank overshoot here, causing a recession, or a worse recession than perhaps necessary. And then finally, there's always a chance of something breaking in the financial markets. Now, the banks are in much better shape now than they were in 2008. Nevertheless, you can have unexpected things happening, like we saw with the pension funds in the UK. We've seen recently, of course, the crypto problems, although that's hardly unexpected. But nevertheless, something could go wrong here, which could bring risk assets down generally. Here's where we are on valuations. This is the cyclically adjusted PE ratio, following the example of Robert Shiller. You can see how much it has come down in the US in particular, but not down to 2009 levels. So this is not ragingly cheap by any means. It's still about 28 times in the US. You can see the Eurozone and the UK have come down. Again, they're still not back to 2009 levels. Not that they necessarily should be, because that was a really bad time. But it does say that we're back at reasonable valuations, but these are not necessarily opportunity of a lifetime levels. And if you compare US stocks with bond yields, then they've actually become more expensive this year. This is a measure called the excess CAPE yield, which takes the inverse of the price earnings ratio, the CAPE price earnings ratio, and compares it to the 10-year bond yield. So you can see back in 2000 how expensive it was. The CAPE yield was negative, almost 0.2%. And you can see how it's actually become more expensive this year. That's just the last downstroke on that chart. But you can also see that it's not too badly valued if you compare with the long period. But nevertheless, it's worth bearing in mind that bond yields have moved such a lot this year that although stocks are down, in relative terms, they have become more expensive. And if we look at bond spreads, this is high yield spreads and triple B, they've come up and they're much more attractive than they were. High yield bonds, for example, can offer over 8% now on average. So that's obviously pretty high yield, quite attractive. But if you compare with, excuse me, with recession levels where these spreads go very high, but even periods of stress in the market, like back in 2014, 2015, or 2011, we're not at particularly high levels here. The same goes for the triple B corporate spreads, up, but not very high, not really at real stress level high. So if you get a recession, these yields can certainly go, these spreads, I should say, can certainly go higher. The second risk I want to highlight is China-US tensions. This is affecting supply chains, it's affecting the way companies operate. That's certainly worth looking at. We're also seeing protectionism in general, but also quite targeted in terms of technology. We've got the potential flashpoints. And we've also got, I would say, risks in China and related stock markets. So just thinking about China in general, I think that it's a problem really for Western investors as to what to do. The market is cheap, but there's so many bad things going on. The economy is very sluggish. The zero COVID policy is struggling. Right now we're seeing, as we expected, a kind of winter surge in cases. That's not going to go away, but when they close down the economy, and about a fifth of the country is affected currently, that has an impact on production, but also on demand. People can't move around, can't shop. But even if we didn't have COVID, I think China would be in difficulties because of the property slowdown, which is not over. That's affecting the whole economy because it's about 25% of the economy when you consider construction, but also all the components that go into houses or flats. They have major structural problems. They've overinvested, so really there's no real point in investing from here onwards. They've got very high debts. It used to be just corporate debt, but now it's government debt and consumer debt. So they can't rely on credit to get growth going anymore. So I think going forward, we have to think of China as a 2 to 3% growth economy. They may report a bit higher than that, but I think that's the reality. You could call it the middle income trap if you're familiar with that term. And it does mean China is likely to underperform the rest of Asia, which is a big change from the last, 30 years or plus. As I said, stocks are cheap, but with these problems and others, are they investable? I mean, the other problems are the lack of transparency in China, the policy changes, which have become more populist and more anti-business, I would say. If you look at other Asian markets, I think they're more attractive than China, but they could also face the broader US-China risks issue. Here is the cyclically adjusted PE ratio for China. You can see how low it is, lower than it's ever been, in fact. We've had a bit of a rally in the last 3 weeks or so, but still very low. Big contrast with India, which has been doing quite well, I would argue, is rather highly valued at the moment. And my third risk, the US dollar may have peaked. We've seen a reversal in the last couple of weeks. The reason for peaking, I think, is that the US is probably getting close to the top for interest rates. And as that becomes clearer, I think it shifts the balance away from the US dollar. The risk here is for UK investors who've, looking at their portfolios, have not done so badly this year, because although some of their US and other international stocks may have come down in local currency terms or in dollar terms, they don't look so bad in sterling. But if sterling is going to rise in the next few months, year or two, that could change. Sterling could easily rise 10%, maybe more. So that would essentially reduce the value of any increases in other markets. So with that, I'm going to turn over to Gerry to talk about some opportunities.
Thank you, John. If you could change the slide over. Thank you. Now, at Tricio, we like to do things in threes. So we're going to have three opportunities to focus on. And I'm going to go through these charts and explain why we think what we think. And then we're going to leave a lot of time for questions where John can try to explain what the heck I meant, if that's okay with everybody. So the three opportunities that we're seeing, 60-40 portfolio may rise from the ashes. We're looking for a mid-cap recovery in the UK. And we're looking for Japan to do well, even with a stronger yen. John, next slide, please. Now, this is a slide that, or a graphic that many of you have probably already seen. It's from Bank of America. And as far as I'm aware, every single publication published it, because this summarized the shock that we had this year, where at one point, 60-40 portfolio returns, this is looking at US markets, were down over 30% year to date. And that's not something we're used to. We all like the idea of holding bonds in a portfolio in order to cushion potential falls in equity valuations or stock market prices. What happened this year, though, is a continuation of what we saw from early 2020, which was that bond yields went up. Bond yields crashed. We had some in negative territory. We had some flirting with negative territory, looking at UK, US, Eurozone. And then you had the recovery, and bond yields rose and rose and rose and rose. And then we had the Ukraine war, where all of a sudden we had a huge influx of inflation fears and commodity prices surged. And next thing you know, bond yields were climbing very sharply this year. So we had the rare occurrence where both bond prices fell sharply and stock prices fell sharply. And everybody's been writing about it, is it 60-40 portfolio dead? We don't think it is. Next slide, please, John. Namely because, one, we like bonds as part of a portfolio. John did some really great long-term real return studies going back to the 50s, I think. And it's one of those things where on a long-term basis, bonds really do okay in a portfolio. They offer you some yield and they offer you some potential protection in really tough times. And the way we look at it right now, global bond yields have climbed a lot since early 2020. And we think 2023 and 2024, they're going to give you some of the portfolio balance that you would expect normally. And we could actually see some positive returns depending on the depths of the recessions that are hitting or going to hit Eurozone, UK, US economies. And so these charts show, the one on the left, global 2-year yields, and you can see that there are some attractive 2-year yields out there, and also the 10-year yield on the right-hand side. And again, these are attractive. Now, we're not making any bones here. These are probably all still negative in terms of real terms. But if you expect inflation to be tamed or at least come under control in 2023 and 2024, then these yields should actually be attractive for a medium to long-term investor, or at least offer some much more attractive returns than they did back in early 2020 when we saw yields get really, really low. So that's one of the reasons why we think that 60-40 portfolio is going to do well, or at least do a lot better in 2023 and 2024. One, we don't expect stock markets to fall a heck of a lot more, maybe 10%, 15%, even 20% is possible. But if we get a mild recession, then that may not be seen. And as John pointed out, we don't expect bond yields to come down sharply, but we do expect them to stabilize. And we think we're probably closer to the highs in most of the countries we look at than we are to seeing another doubling in rates, for example. Next slide, please, John. Now, John pointed out that there could be some sort of pullback in the dollar, where we could see cable, sterling against dollar, move away from 118, 115, where we are now, and start pushing back above 120, 125, 123, back towards the 130, 140 area over 2023 and 2024. Now, this seems like an aggressive call, but it isn't. Basically, it's just mean reversion, which is what FX markets do when they're not trending. And we think the reason, exactly what John pointed out, the reason we're not going to see a huge dump in the pound anymore is that you've seen dollar rate expectations start to normalize. They're starting to say we're probably closer to a peak in terms of Fed funds than we are to see them push rates, let's say 8% or 10%. Not many people think that. Most people think 4.5%, 5%, 6% at a stretch, and even that's getting a bit frothy for most people at this stage, mostly because a couple of weeks ago, we all saw that little dip in CPI, which doesn't mean much in the long run, but for FX traders, it meant quite a lot. And you saw cable push away from 112 up towards 118. Euro dollars pushed away from 98.99 back up to 103 and flirted with 104 on a break. So if you put that to one side, that's going to be basically a sterling positive story. Then we're looking at the FTSE 250 as the big crash that we had this year. And at one stage, we're down over 30% here as well. We think that's going to be partially reversed. Now, the reason we like a FTSE 250 is when we look back over the last 20 years plus, it actually does pretty well relative to the FTSE 100. As many of you know, the FTSE 100 is the biggest market cap index in the UK for stocks, but it's not really UK PLC. It's a bunch of big banks, big petrol companies, energy companies, pharma, miners, and the usual suspects are there. The biggest banks are not actually UK banks, they're Asian-focused banks and that sort of stuff. So while the FTSE 100, we liked it a lot in the first 6 months of this year because of the dollar earnings and the soft cable, or soft sterling. It's one of those things where we thought that probably has run its course. We've seen a lot of the energy markets start to price out $140 Brent. That's probably not on the cards in the near term. And $65 Brent might be more likely. We've also seen that we are looking towards less dollar earnings and the view that sterling is going to rise, as I said. So we think the FTSE 100 might struggle to make new highs, whereas the FTSE 250 probably will recover ground over the next 2 years, in our view. Now, there's lots of ways to play this. The FTSE 250 is a smaller cap index, and you could look at the FTSE All Share. So instead of saying, okay, I'm just going to do FTSE 100, maybe the FTSE All Share gives you more of what we're talking about in terms of exposure to companies that might do well as sterling recovers. Now, keep in mind that the FTSE 100 is around 80% of the FTSE All Share as well, but at least you're getting a 20% kicker from the mid to small cap firms. Next slide, please, John. And finally, we expect the Japanese yen, as we talked about in terms of dollar topping, to actually do well against the dollar over the next year. And we're looking for 130, maybe 120. Now, the Bank of Japan intervened a couple of, two times, I think, over the last few months. And the estimates are they spent over, $40 billion in trying to lean against the market. The Bank of Japan is not expected to change their policy rates. So we don't expect them to give up on yield curve control anytime soon. So that means that you're still going to have relatively low rates in Japan. However, currencies are made up of two factors. One is the yen, Bank of Japan, rate expectations there. And the other one is Fed. And as John pointed out, people are thinking the Fed is near to a top in their rate hike cycle. So that took some of the froth out of dollar yen as well. Now, the chart on the left shows the topics and dollar yen. And the story that we've always been told since we were kids, and that's going back a long way for me, is that if the Japanese yen firms, the topics will fall. That doesn't necessarily hold true all the time, though. Okay, so we think we're going to be in one of those occasions where the yen can firm or even consolidate, if you will, and the topics can continue to do well, right? So by topics doing well, I mean hold up or actually push higher. Either one is fine as long as the yen firms and you're on the yen side of any exposure through your fund holdings. The chart on the right shows the Japanese shares in dollars and dollar yen. And it's one of those things where we're looking for dollar yen, which is a blue line, to potentially come back a bit, which the topics in dollar terms means it should actually pop higher. Because right now we saw the topics in dollar terms take a big hit this year, even though the actual index didn't fall that much. Dollar yen's climb pushed the topics in dollar down around almost 20% at some stage. So it's one of those things where we think international exposure from international investors into the Japanese market should be rewarded by one, the stock market holding up, and two, the yen firming a lot. Now I'm going to hand over to James, who's going to speak about some of our summary outlooks and challenges.
Yeah. Thank you, Gerry. Thank you, John. I think I'm just summarizing what John and Gerry with this slide. At the beginning, John talked about some themes and trends. Some of them will continue, and some are actually looking at a more positive note, may represent opportunities. New technology, hopefully trying to boost up productivity, and obviously green transition, climate change. We have just finished COP27. These are actually opportunities, but advisors and investors need to be cautious. FUD is, I'm borrowing it from the crypto world. It's basically fear, uncertainty, and basically also possible understanding that you need to do more. So this is the type of things we need to do, is to make sure that we deal with these opportunities with some fear, uncertainty, and doubts, making sure we understand what is there. Especially nowadays that we're seeing in the crypto world and other technology side, businesses are now run by more like by salesmen, very eye-catching words and very interesting behavior, compared to the good old days when boring business competence is more important. We still think actually business competence is important, and this is when advisor investors need to understand which technology, which green transition opportunity is really well going after. So this for the longer run. But I think for 2023, we talk about 3 risks. And interestingly, our conclusion is that that's what I think everyone should be focusing, managing the risk on the first half. The possible recession, there could be further fall in asset prices. We talk about China, we talk about the zero COVID policy impact, etc., and the dollar peaking. So all this can affect performance. But as this actually turn into the second half of 2023, especially when dollar has shown its peak and the Fed basically stopped its hike, have shown actually that they are going to end the hiking very soon, then we will see opportunities. This opportunity looks quite contrarian or quite strange at the moment. Why do you talk about it? Why do you talk about bonds, especially investment grades, in 60-40 portfolio when yield keeps going up? Well, maybe there's something that we can look at in the middle of next year when yield probably will peak. And this is the time when bonds will play a good role in portfolios. UK mid-cap, why do we doing it now? Especially with UK now having a shock in September, October with Liz Truss brief government. Why do you want to do this with recession coming? Well, it's cheap, valuation bottoming. And as Gerry pointed out, sterling probably will recover at the second half of 2023. Opportunities there. Japanese stocks, again, cheap. At the moment, it looks terrible, the performance, especially because of yen weakening against dollar and other currencies. But when dollar has peaked, yen will start strengthening again. And also that may actually bring into some case to diversify into Japanese stocks. Contrarians like now, but could be actually good opportunities for 2023. But I think that's all we are feeling. Well, with this note, thank you, everyone. We'll end this webinar. As I said, we have the recording and the slides will be sent to all the attendees. We probably won't see each other, everyone, until 2023. On this note, we do want to emerge from permacrisis. So we hope that next year at the same time, we'll talk about how happy 2023 has been for all investors. On that note, thank you, everyone.